Today, we're unpacking a massive, newly proposed shift in the retirement landscape. We're going to dive right into the details of a recently signed executive order that outlines a brand new marketplace, what people are calling the Trump IRA. And more importantly, we're going to see exactly how it stacks up against the reigning champion for young savers, the traditional Roth IRA. If you're trying to figure out the best place to park your hard earned money, well, you are definitely in the right place. To make sense of these complex financial shifts, we're breaking this down into 5 logical steps. We'll hit the 401k access problem, look inside the Trump IRA, check out the free money catch, talk about risky new 401k assets, and finally, do a Trump IRA versus Roth IRA showdown. All right, section 1, the 401k access problem, or as it's often called, the retirement gap. So let's look at the broken system these new rules are actually trying to fix, which is the traditional employer-sponsored 401k, 56 million. That staggering number represents the amount of Americans who currently have zero access to a retirement plan at their job. We're talking gig workers, freelancers, solo entrepreneurs, and employees at small businesses. Literally millions of people locked out of the easiest, most automated way to invest for the future. And honestly, it gets worse because even if you are lucky enough to have an employer sponsored 401k, the plans are, well, they're frequently pretty awful. You're often stuck with atrocious funds that charge an arm and a leg in fees. And those fees quietly eat away at your compounding returns over time. It's just a reality that a lot of employers don't take the time to pick reasonable, low cost options for their teams. Moving on to part 2, inside the Trump IRA and this new marketplace. This new executive order targets that exact gap we just talked about. Here's the proposed timeline based on the order signed back on April 30th. The goal is to create a one-stop shop website scheduled to go live on January 1st, 2027. This platform is designed to connect American workers who don't have employer plans with pre-screened, high-quality, and low-cost private IRAs. And if you meet the requirements, the government incentives for using it would likely show up the following year, in 2028, right after you file your taxes. A major draw here is the targeted cost savings. Look, some traditional 401k funds can charge anywhere from 0.2 to an insane 5% a year in fees. The new marketplace strictly caps total fees at 0.15%. So yeah, while that's still slightly higher than what you might pay for a standard Vanguard index ETF, which usually sits around 0.03%, it's an absolutely massive improvement over the expensive alternatives most workers are stuck with today. But the real headline grabber of this entire program, and the reason it is getting so much attention, is the Savers Match. Starting in 2027, the federal government proposes depositing up to $1,000 a year into your qualifying retirement account as a dollar-for-dollar match on the first $2,000 you contribute. Just think about that for a second. That is essentially a guaranteed 50% return before your money is even invested in the market. It's a huge deal. So how do you actually claim this? It's a 3-step process. First, you save and deposit the $2,000. Second, you have to fall under some very specific income thresholds, which we'll look at in just a second. And third, assuming you hit those marks, the government drops the $1,000 match into your account the following year. Which brings us to section 3, the free money catch and those strict income limits. The crucial point here is that this free money comes with some extremely low income thresholds. If you're a single filer, you only get the full $1,000 match if you make $20,500 or less. The bonus begins to phase out, and it disappears entirely if you make over $35,500. If you're married filing jointly, the full match is available up to $41,000 in household income, completely phasing out above $71,000. So if you earn a single dollar above those phase-out limits, you get absolutely no match whatsoever. The harsh reality for young savers is laid bare right here. Think about it. To max out this benefit, as a single person, you need to come up with a spare $2,000 to invest while earning roughly $20,000 a year. That means you have to save a full 10% of your gross income while effectively making near minimum wage. For most people living paycheck to paycheck at that income level, pulling together $2,000 to lock away for retirement is going to be incredibly difficult, if not totally impossible. Next up, section 4, risky new 401k assets, opening the door to alternatives. Before our final comparison, we really need to touch on the second, somewhat wilder half of this proposal for existing 401ks. It aims to let 401k plans offer alternative investments. Depending on how regulators actually finalize the rules, this could include things like private equity, private credit, real estate, and maybe even digital assets like cryptocurrency. The stated goal here is to democratize investing. They want to give everyday workers access to the same high upside, professionally managed private deals that billionaires, endowments, and pensions have used to build wealth for decades. However, this introduces a massive new layer of risk. As context from the Department of Labor highlights, employers have a strict fiduciary duty to ensure the funds they offer are safe. By opening up retirement plans to highly speculative private assets, everyday workers could potentially lose their life savings. And that, in turn, could lead to companies being sued into oblivion by employees claiming a breach of that fiduciary duty. Think about standard index funds for a minute. You know exactly what you own, the fees are low, and the values update daily. Private assets? They're the exact opposite. They're incredibly hard to value, they carry much higher fees, and they're highly illiquid, meaning your money could be locked up for years or even decades. Sure, a few people might hit the jackpot investing in a pre-IPO company, but critics warn the average person is way more likely to end up stuck in expensive, complicated products that benefit Wall Street managers far more than actual retirees. All right, Section 5, Trump IRA versus Roth IRA, the ultimate showdown. Bringing this all back to your wallet, you face a major fork in the road for your financial strategy. The Trump IRA gives you a small upfront government incentive, but only if your income is exceptionally low. The Roth IRA, on the other hand, operates totally differently. You fund it with money you've already paid taxes on today. There's no government match, but in exchange, every single dollar of growth compounds entirely tax-free for the rest of your life. Let me show you why that matters. $2.5 million. If you contribute the current maximum of $7,500 a year into a Roth IRA starting at age 20, by the time you retire at age 65, assuming standard market returns, you could be sitting on nearly $2.5 million. And because it's a Roth account, you can withdraw every single penny of that fortune completely tax-free. No way around it. That is huge. The sheer math behind why the Roth is so powerful comes down to this. Out of that $2.5 million, over $2 million is pure, untaxed profit. In a traditional pre-tax account, you would eventually owe ordinary income taxes on all of those millions upon withdrawal. But with a Roth, because you paid a little bit of tax up front when you were young and in a lower tax bracket, the IRS literally cannot touch your multi-million-dollar gains later on. So let's distill all of this down to the final verdict for young savers. Number one, if you're making under $20,500 and can genuinely afford to save $2,000, absolutely take the free $1,000 government match when it becomes available. Number two, if you're single and making over $35,500, the new proposed IRA doesn't offer you a match anyway. Number three, if you're young and in a relatively low tax bracket, you are mathematically better off paying taxes right now. Prioritize opening a Roth IRA today, which, by the way, you can do in like 5 minutes on your phone, and focus entirely on those decades of massive tax-free compounding. As you map out your financial future and navigate these new potential rules, you have to ask yourself this. Are you chasing a small upfront match today, or are you building a tax-free fortune for tomorrow? Which strategy truly maximizes your hard-earned money over the long haul? Let